Hey everyone, welcome back to Corporate Decoder, the place where we try to read between the lines of corporate filings, and today, oh boy do we have a story to unpack about CervoMed Inc, or Cruvo as they trade on the Nasdaq. Let's just say this report feels like a nail-biting cliffhanger, and we are about to find out if our protagonist can make it to the next act. If you appreciate getting the real story behind these financial documents, make sure you are subscribed and hit that notification bell. We also have a Discord community linked in the description below where we break down these filings in real time, so come hang out with us. So what is this document? Exactly, it's a quarterly report filed with the SEC for the period ending the 30th of September 2025. Think of it as a mid-season check-up for the company, giving us a peek under the hood of their financial health and their ongoing journey. Now let's dive into the numbers right off the bat. Looking at their balance sheet on the 30th of September 2025, CervoMed had about $9.4 million in cash and cash equivalents. That's important because the company has been losing money and needs cash to keep operating. So this is a key number to watch. They also had about $17.8 million in marketable securities, which are like short-term investments. When we look at their income statement for the 3 months ending the 30th of September 2025, their net loss jumped to almost $7.7 million. Now compare that to the same period last year, the 30th of September 2024, when they lost about $4.7 million. That's a significant jump in losses over a year, and that is something we need to pay attention to. This means their expenses are growing faster than the money coming in. Looking at the equity section, we can see the accumulated deficit climbing to a staggering $89.6 million by the 30th of September 2025. This means the company has lost a lot of money since it started. The number of common stock shares outstanding also increased to over 9.2 million shares, reflecting recent stock issuances. The cash flow statement tells us where the money is actually going. For the 9 months ending the 30th of September 2025, the company used nearly $16.9 million in cash just to run its operations. Now that might sound like a lot, but for a clinical stage biotech company, this is often where the bulk of their spending goes. They are essentially pouring money into research and development. Investments also took a big bite out of their cash, with over $20 million spent on purchasing marketable securities during the 9 months ending the 30th of September 2025. On the flip side, they brought in about $4.6 million from financing activities through their at-the-market offering program. This next section is super important. It directly addresses the elephant in the room, the company's ability to keep the lights on. They state they have about $27.3 million in cash and marketable securities as of the 30th of September 2025, but they expect to continue generating operating losses for the foreseeable future. This raises substantial doubt about their ability to continue as a going concern. Basically, it means unless they can raise more money very soon, they might not be able to operate for much longer. They explicitly say they do not believe their current cash will last at least 12 months from the issuance of these statements. Here they explain how they account for things like stock-based compensation and grant revenue. Grant revenue comes from things like their NIA grant, a substantial chunk of funding that helps them research Alzheimer's and dementia-related diseases. For the 9 months ending the 30th of September 2025, they recognized almost $4 million in grant revenue, which is down from $7.6 million last year. This drop makes sense as a major trial might be wrapping up. This part is about how they value their investments. They are mostly investing in commercial paper and corporate debt securities, which are considered relatively safe. On the 30th of September 2025, their marketable securities were valued at about $17.8 million. This note details their major deals. The Vertex agreement is a big one. It involves licensing a drug candidate, VX745, and comes with significant future payments and royalties. Then there is the NIA grant, a crucial financial lifeline for their research efforts. They have received a good portion of it, but there is still some uncertainty around the final payments due to government funding resolutions. This is where they talk about any potential legal battles. They mention a lawsuit filed by their former CEO Paul Feller dating back to 2014. The case has been through a lot of back and forth, and the trial date keeps getting pushed back. The company is defending itself, but the outcome is uncertain and could impact them financially. This section details capital raises. In April 2024, they raised about $50 million through a private placement. More recently, in May 2025, they entered into an at-the-market offering program with a potential to raise up to $50 million, and they have already sold 550,000 shares for $4.7 million. This shows a clear strategy to raise capital to fund their operations. Here they talk about stock options granted to employees and executives. You can see they recorded over $1.1 million in stock-based compensation expense for the 9 months ending the 30th of September 2025. This is a common way for tech and biotech companies to incentivize their teams. They also mention a separation agreement with their former chief operating officer, which resulted in some expense recognition. Moving on to management's perspective, they are upfront about their lead drug candidate neflamapimod and its potential for age-related brain disorders like dementia with Lewy bodies or DLB. They believe they are a leader in treating DLB and have seen promising results in their clinical trials. They are also planning a phase 3 trial, which is a huge step. They explain that neflamapimod targets neuroinflammation, a key factor in brain diseases. They have seen positive results, especially with a new batch of drug product called Batch B that delivers better plasma drug concentrations. The data from their rewind. LB trial has been presented, and it shows a significant risk reduction in clinical worsening, which is very encouraging. They are even aligned with the FDA on their planned phase 3 trial design. A really interesting detail here is their investigation into why an earlier batch of their drug called Batch A did not perform as well. They identified issues with polymorphic forms of the drug ingredient and are now implementing improvements to use a more stable form in future trials. This shows they are actively addressing manufacturing challenges. They reconfirm their cash position of $27.3 million as of the 30th of September 2025 and their ongoing losses. They highlight their dependence on future financing and the substantial doubt about their ability to continue as a going concern. This is a recurring theme and a critical point for investors. For revenue, they are primarily relying on the NIA grant, which as we saw is decreasing as trials progress. There are no product sales yet. As expected, research and development expenses are their biggest cost. For the 9 months ending the 30th of September 2025, these expenses were about $16 million. That is a significant increase from about $11.7 million in the same period last year. This is driven by new clinical trials for stroke recovery and frontotemporal dementia FTD programs. Their general and administrative expenses also increased to $8 million for the 9 months ending the 30th of September 2025 compared to $6.9 million last year. This is largely due to increased personnel costs. Looking at the 3-month period ending the 30th of September 2025, they reported a net loss of $7.7 million, up from $4.7 million last year. Grant revenue decreased significantly by $1.6 million, while research and development expenses increased by $915,000. For the 9-month period ending the 30th of September 2025, the net loss was almost $18.9 million, a substantial increase from $9.6 million in the prior year. This widening loss is primarily driven by increased research and development spending. This section reiterates their need for capital. They have a cash runway question mark over their heads and are actively pursuing fundraising through equity offerings and other means. They also acknowledge that capital markets volatility could impact their ability to raise funds. The cash flow statement for the 9 months ending the 30th of September 2025 shows $16.9 million used in operations. Investing activities used $12.7 million mainly in marketable securities, while financing activities provided $4.6 million from stock sales. As a smaller reporting company, they are not required to provide detailed market risk disclosures. This is where they discuss their internal controls. They frankly admit to a material weakness in their financial reporting related to identifying, evaluating, and recording expenses. This is a red flag and they are actively working to fix it. They expect remediation within the year, but admit the process is ongoing and there could be more issues found. Despite this, they believe their financial statements are still fairly presented. This part contains less financial detail, but covers things like legal proceedings, which we already touched upon, and risk factors. The main risk factor highlighted here is their history of operating losses and the substantial doubt about their ability to continue as a going concern. This confirms the severity of their liquidity situation. They also point out that capital market volatility can make raising funds difficult. Finally, the exhibits list all the supporting documents for this report. Now for the big picture, CervoMed is in a high-stakes game developing treatments for serious brain disorders. They have a promising drug candidate neflamapimod and positive data from key trials. The alignment with the FDA on their phase 3 trial is a significant milestone. However, the financial reality is stark. They are burning cash at an increasing rate and their ability to continue operations is a major concern. The material weakness in internal controls is also something investors will be watching. They are clearly trying to manage multiple challenges simultaneously, from drug development to financial sustainability to strengthening their internal processes. It's a classic biotech balancing act. The company needs to hit its next clinical and regulatory targets to justify the ongoing investment and secure future funding. Alright, that is our breakdown of CervoMed's latest filing. What is your take on these numbers and what they signal for the company's future? Do you see them navigating these challenges and successfully bringing their drug to market, or is the going concern risk too high? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.